I'm going to be talking to Olivia Beisel from Carbon Tracker about some modeling around LNG they've just included in a report about Canada. And Olivia, in the first interview, we talked about how LNG demand, there's going to be a big glut of supply between now and 2030, like 50% more supply. Markets are going to be oversupplied for a long time. Then in the second interview, we talked about how Canadian LNG is not low cost, it's sort of mid to high cost. Not very competitive, which is one of the reasons why we haven't had final investment decisions on a lot of these projects. But now we're going to talk about the narrative and why the industry continues to insist that LNG is kind of its salvation. It's a hedge against risk for domestic gas demand declining over time. Why do you think that is? What's behind the narrative?
Well, look, I think Canada is going through a lot of economic challenges, much of which is stemming from US trade pressures, of course. And so there's a temptation to look to the past and say, this has worked for us. This is what we should do to get us out of this challenge and take us into the future. I think there's also, as we've talked about previously, a lot of narrative around the environmental attributes of the oil and gas produced here in Canada, which we don't need to talk about further, but I think that all plays into this narrative of Canadian oil and gas having a quite significant and growing role in the world. But when you look at the cash flow analysis and look at different transition scenarios, so different paces at which renewables would be substituting demand for oil and gas in the coming decades, this narrative by the industry just doesn't really hold up against reality of economics. And ultimately, it's the economics that is driving where buyers are selecting.
Yeah, let's talk about the risk. The downside risk is at the lower end of pricing. The Canadian LNG projects are just not economic, and
Right.
they would probably fail in short order. But what's really interesting is that the upside benefit of higher prices, the benefit is not that great.
Mm-hmm. Yeah. So we looked at this issue for the 10 largest Canadian oil and gas companies at the portfolio level, but then we also drilled into this issue for significant gas producers, a subset of those 10 companies. And we're finding that business as usual investment in new gas projects would erode the value of producing assets by around 100% under a fast-paced transition scenario. So this is essentially saying companies are better off not producing new gas or not investing in new gas projects. Now, of course, you have to look at the big picture of a potential upside. What if the transition happens slower? And so we include this in our analysis. We include the full set of plausible energy demand scenarios. But we find that the downside risk under a fast-paced transition is about 2.5 times the upside for gas in particular. And it's this ratio of risk to return that's particularly relevant for investors who are weighing different possibilities when they're making investment decisions.
Now, I don't know what it's like in British Columbia, though a lot of the companies that produce gas there are based in Alberta. But I
Mhm.
have seen the Alberta Energy Regulator data, and it's a very lopsided kind of industry. Tourmaline, for example, produces a huge percentage of all of the Alberta gas. And so you've got these, Tourmaline at the top, and then you've got a small number of sort of medium-sized producers, and then the rest of the industry is all, little guys,
Mhm.
little companies. And so one could maybe argue that, if there's any downside risk, a company like Tourmaline could probably weather that better. But so much of the industry is made up of these little players where a small swing in prices and they're bankrupt.
Right.
And
Yeah,
then, yeah, sorry, go ahead.
I think that's a great point. So we're, of course, looking at the largest players in the sector and finding the downside risk to massively outweigh the upside. And you can only imagine what this risk return profile would look like for the smaller players. To your point, they don't have these massive scales, economic scales that favor their economics. And so our analysis points to just a subset, but it's important to look at the bigger picture, which could be far worse.
Now, here's an interesting point, and it's very hard to get someone to speak on the record. Off the record, yes, but on the record, no, because careers would be at risk. And what they say is that, look, the Premier Danielle Smith and her United Conservative Party came to power, and Smith is a former oil and gas lobbyist. She was registered in 2019 and up until she became premier in 2022. And a lot of her political support doesn't come from the big companies. It comes from those small to medium-sized companies, what in Canada we call the juniors. That's kind of her political base. And she said over and over and over again publicly, she said, we have to do something to help those small companies.
Mm-hmm.
And what's going on quietly behind the scenes, I'm told by people who are in the know, is the fact that, you know, the Alberta Energy Regulator, for example, when some of these companies are essentially insolvent, they should, you know, they should be shut down and their assets appropriated by the regulator, and they kind of get winked at. You know, so it's like, well, look, we don't want those companies to go bankrupt, so we're going to bend the rules here. We're going to let them get away with things. Maybe they don't pay their taxes, or maybe we you know extend some you know bend the rules for them.
Mm-hmm.
That's a danger. This is the problem where the industry is, you know, kind of sunsetting in many ways. And we've seen this in other industries. The first thing an industry will do is go to the government and say, I want to be subsidized. I want the rules relaxed. I want special dispensations here and there. And then that leads to all sorts of long-term problems because eventually they never get resolved.
Mm-hmm. Yeah. So I think I can speak to this in terms of the new projects in particular, because that's what our analysis focus on. That's kind of where companies have decisions of whether they're willing and going to sink massive amounts of capex into these projects. And it comes back to the question of what is in the best interest of the company. And I think what our analysis is showing is that these new gas projects are not necessarily in the best interest of the company's bottom line when you're considering plausible energy demand scenarios that are rooted in the reality of the transition, and not kind of overly bullish assumptions that are at odds with the levels of technological progress that we've seen in recent years. So it really comes down to what is in the best interest, and new projects are not necessarily that.
Well, let's talk about that for a moment, Olivia, because here at Energy Media, and folks, if you want to go to our Substack, Thoughtful Energy Journalism, you can see a couple of essays that I've written. We've done some videos about this, but we've looked at the various scenarios. So generally, they can be lumped into three types. One would be the very optimistic, very, very bullish, which is like OPEC, which is the new IEA current policy scenarios. You know, they see significant growth out to 2050. Then there's like the IEA steps, which is kind of a business as usual, and it kind of bumps along as a plateau out to 2050. And then you have the scenario of the IEA's APS. And so what we've done in our work is, because we're not economists, we're not modelers like you are, Olivia, but what we can do is we can compare the assumptions behind the modeling to the actual evidence on the ground and the trends that we're seeing out. And what we've concluded is that the IEA's APS scenario is the most likely outcome. And that shows by 2050 a significant decline in LNG demand globally, and also oil demand falls by about half. Now, my question to you, Olivia, that's what conclusion we have come to. But my understanding is that you have also, in your modeling, come to view the APS as the most likely scenario.
Well, we consider both the APS alongside steps. At Carbon Tracker, we don't predict which scenario will come true. We're really modeling a range of exploratory scenarios based off of inputs that are unfolding in the policy environment. So we do model both of them. However, I will say that regardless of which one you believe will be true, you have to take into account the downside risk alongside the upside. And I think one highlight I'd like to point out to in our analysis of gas projects in particular is that when you're looking at even a moderate pace transition scenario, somewhere between APS and steps, new projects are still value destructive. So you don't even have to believe that the transition will unfold quickly for the risk to be very relevant and real.
Yes, I would agree wholeheartedly, and I this reminds me of my one of my favorite sayings about Alberta. You know, Mom says, "Hope for the best, plan for the worst." Alberta says, "Plan for the best, and worst?
Mhm.
What worst? We
Yeah.
don't plan for
Yeah.
worst. We don't need no stinking worst here." And that then becomes the problem is that only the when like companies that's if they're going to risk their money and there's no public money involved, that's one thing. But in all of these projects we're talking about, you know, like liquefaction plants and pipelines, and we're talking about expanded gas production up in the northeast of BC, public money is going to be involved. That's
Right.
the prime minister has made that very clear that he's coming with the big red checkbook from Ottawa, and there's going to be public money put at risk. That then, I would argue, absolutely necessitates the inclusion of downside risk into the calculations, into the business case, and that specifically is not happening.
Absolutely. And I think it's not just a risk for the companies and investors, but also for the banking sector. If you look at the big five Canadian banks, 18% of their financing last year was tied to fossil fuels. And so this has serious implications for the portfolios, but within the oil and gas sector, but also for the broader economy, considering that lending could be affected by a depression in the oil and gas sector. Um, and then taking a step back at the implications for fiscal risk, my colleague Rich Collett White recently did an analysis of this. And for the petro provinces, Alberta, but also several others that are driving a large proportion of revenues from the oil and gas industry, they really need to be thinking about this downside risk to inform policy so that they know what diversification measures they need to take so that the economy can be resilient to the future.
I can tell you what diversification measures Alberta is taking. Bupkis. Zero. And I know because I advocate for these diversification things like turning bitumen into carbon fiber or scaling up geothermal, advanced geothermal, you know, all of those things. And nobody's they turn a blind eye because everybody, the lemmings are stampeding towards the oil and LNG cliff, and nobody's paying attention. But enough of my moralizing here. Olivia, thank you very much. It's been very insightful.
Thanks so much, Mark. I appreciate your time.